Hey everyone, it is KAF here with KAF Investing. Today I'm going to be talking about moving averages. What are they and how do you set them up in the ThinkOrSwim platform? Now, if you already know what they are, go ahead and fast forward a few minutes where I explain how to set them up in your ThinkOrSwim platform. For everyone else, so let's go ahead and get started. Now, there's quite a few different types of moving averages, and I'm sure you've heard them before. There's SMAs, EMAs, DMAs, MACD, etc., etc. There's all sorts of different names. But although it appears to be quite complicated, once you get the hang of things, it's really not that bad. So let's start talking about the SMAs here, the simple moving averages. Now you'll see there I have the word lagged. You can kind of ignore that for now, but keep in the back of your mind that the simple moving average tends to be a little bit more lag data compared to an exponential moving average. And again, I'll explain that in a second when I show some real charts and I have the simple moving average overlaid with an exponential moving average. But a simple moving average, it is quite simple to calculate and to figure in. Let's start talking about a 50-day moving average, or also known as a 50 MA. Now, to figure out a 50 MA, all you're going to do is take the closing price over the last 50 days, and you're going to divide it by 50. So in other words, just take the average closing price the last 50 days. That will give you the 50-day moving average. Same thing, if it's a 200-day moving average, you simply take the average closing price of the last 200 days. Now, you yourself can put in whatever moving average you want. You could do a 3-day moving average. You could do a 500-day moving average. You have a lot of flexibility with what you're looking for. Now, most people tend to use the 50-day moving average and 200-day moving average when looking at golden crosses. And I'll explain a little bit about golden crosses shortly. That's a very bullish technical setup. And so we will address that here shortly. But let's move on to the EMAs. Now, how are EMAs, or in other words, the exponential moving averages, different than the SMAs or simple moving averages? Well, exponential moving averages are going to weight certain days differently. And that will make a little bit more sense again as I move on shortly. But with a simple moving average, every day in your calculation is weighted the same. So 50-day moving average, you take your 50 days and divide it by, you find your your closing price of the 50 days, add them up, divide it by 50. That's how you get your 50-day moving average. But with an exponential moving average, it's going to be different. You see I have an example here of a 20-day exponential moving average, or a 20 EMA. It's weighted differently in the sense that the most recent day is going to be weighted with a weight of about 18%. Now, if it's a 40-day EMA, it's weighted at 9%. If it's an 80-day EMA, then it's going to be about 4.5%. So you'll see that weight percentage goes down as the EMA and the time frame that you're looking at increases, but the ratio and the principle is still the same, that the most recent day is weighted more heavily in the calculation. This is going to cause this moving average to trade a little bit tighter with the actual price. You'll see that's where I have tighter there compared to a simple moving average, which tends to be a little bit more lagged and delaying a little bit. Now, all moving averages trade in what we call a rolling window. Now, what do I mean by rolling window? If in this example, let's say we're looking at a 10-day moving average, okay? So each one of these numbers represents a day, days 1 through 10. So when trying to calculate the 10-day moving average, or when you put that study into your ThinkOrSwim platform or whatever platform you're using, it'll simply take the last 10 days, take their closing prices, add them up, and divide it by 10 for a simple moving average. Well, what happens when the next day comes along? As many of you probably could expect, day number 11 comes along, we get that rolling window. And now day number 1 is kicked out of the system. And we're now using this new information, this new closing price on day 11 for our moving average. So this window will continue to roll depending on how many days you're looking at. In this case, it's a 10-day moving average, so it only calculates the most recent 10 days in its price and into its calculation. Now let's talk about golden cross. Okay, you've probably heard this before. It really doesn't have to be too complicated. It's actually very, very simple. It is simply a short-term moving average moving over a longer-term moving average. So when using moving averages, just using one moving average is not overly helpful. You might be able to use them and say it's support or resistance at certain levels. There are times for that, for different technical setups where just using one single moving average is helpful. But typically speaking, when you're looking for breakouts and technical setups, looking for this golden cross is very helpful. And in order to use a golden cross, you need two kinds of moving averages. Again, I will explain this shortly as I bring up live charts, but here is an example of a golden cross. Right here is a golden cross. This blue line represents the short-term moving average. This is the 50-day moving average for this stock. And you'll see the red line is the 200-day moving average for this stock. So here on this, in this example, this blue line, which is the shorter term moving average, as soon as it breaks over this red line here, that's what we call a golden cross, which can be a very bullish breakout pattern. And you'll see the price action does respond accordingly. We have a major spike here in relation to the golden cross. Now, the opposite of a golden cross is known as a death cross, and this is what we have here. It's just the exact opposite. When the shorter term moving average breaks underneath the longer term moving average, we have a death cross anticipating and signaling a major sell-off ahead, which we get here. So this is a really good example of both a golden cross here at the beginning and a death cross here at the end. They're just simply the inverse of each other. Now, let's continue to talk about moving averages. Let's talk about the MACD. Okay, this stands for moving average convergence divergence. Now, there's a lot of big words in there. Don't let that scare you. Okay, I'm gonna try and break it down to be a little bit simple for you. Now, a MACD is calculated by subtracting the 26-day EMA from the 12-day EMA. Now, hopefully remember what EMAs are. We just learned about those on our second slide of this video. EMA stands for exponential moving average. Okay, so the MACD is kind of a special line that was created, and when you pair the MACD with what we call a signal line, it can also help us find certain setups. It can help us find really positive golden crosses and things like that. So this is the calculation for the MACD. MACDs are very similar to just regular moving averages. They just have a slight twist on them in the sense that a MACD is calculated by taking the 26-day exponential moving average and you subtract that from the 12-day exponential moving average, excuse me. Now you'll see there that the MACD is often paired with a 9-day EMA or 9-day exponential moving average. We refer to this as the signal line, okay? And whenever the MACD crosses above that signal line, or also known as the 9-day EMA, that is a bullish signal. If the MACD crosses underneath the 9-day EMA, that is a bearish signal, okay? Now, there are three ways to trade the MACD. I'm not going to get too into the last two. We've already talked about the golden cross a bit, and I'm going to talk about them more here shortly. But there are two other things to note when looking at the MACD. In this case, with the MACD, the black line is going to represent our MACD, and the red line will represent our signal line. So you'll see here in this example, the black line, which is the MACD, breaks above the red line here, which gives us a nice golden cross, okay, which is a bullish signal. Now with the divergence and pull away are both similar in the sense that they are signaling a trend reversal. Divergence is when the 9-day EMA, which is basically following the stock price, the 9-day EMA will follow the actual stock price very closely compared to the MACD. When the 9-day EMA is moving upwards and the MACD is actually moving downwards and they're going in different directions, that means a trend reversal is coming very soon. Now, pull away is slightly different because both of them are actually uptrending, but the gap between the two is getting further and further apart. This also signals a trend reversal, okay? So in this case, these roll stocks, these would actually both be bearish trends signals, whereas the golden cross here in my example is a bullish signal. Now, let's talk about ThinkOrSwim and how to set up these moving averages, okay? So let's go ahead and pull up ThinkOrSwim here. Let me get things situated here. There you are, ThinkOrSwim. Okay, this is quite simple. There's a couple different ways to do this. I'm going to show you the way that is the most simple to me. We're going to go ahead and click on the Studies button right up here in the top right of our corner, as you should be able to see. Click on the Studies button. And then from here, like I said, there's a couple ways to do this, but I'm going to go ahead and click on this Quick Study menu, and I'm going to go down to Moving Averages. Okay, we're going to start with the simple moving average and show how to use the simple moving averages. So after going to Moving Average, you're simply going to scroll up and click on Simple Moving Average. Not too complicated, right? So it immediately will bring up just a default simple moving average. This simple moving average is a 9-day simple moving average, as you can see up here in the top of the screen in blue writing. Just a very simple 9-day moving average, okay? But as I mentioned, just a simple 9-day moving average doesn't really give us much information. It's basically just following the price, not overly helpful. So how can we make this information more helpful to us? Well, the way we're going to do that, we're going to go ahead and click on Edit Studies. Now, when you click on Edit Studies, it's going to bring up this nice box. And what I want to do is I actually want to bring in a second simple moving average because as I mentioned, I want a shorter term moving average and a longer term moving average. So I'm going to go over here to this box and I'm going to scroll all the way down to simple moving average. Again, I think there's quite a few different ways to do this, but this is one that I've kind of have a little bit of a habit of doing. So here is my simple moving average. I click on it. I'm going to click Add Selected, and you'll see it adds it to this list here. Now from here is where we go in and enter the dates that we want, or enter the time frame that we want. So I'm going to go ahead and enter the 50 days, my short term. So I'm going to click on Settings. Right here where it says length, I'm going to go ahead and enter 50 for us. Let's try that again. Let me enter 50 here. And then I'm going to click OK. Next, I'm going to click on Settings for this lower bracket, and I'm going to enter 200. Oh, again, sorry. Here we go. Okay, I'm entering 200 there. So this will now give me two separate moving averages, and I'm going to show you why that's important. I now click OK, and it is now applied to my chart here. Oh, but they are the same color. It is always good to make them a different color so it's a little bit more clear. So let me go ahead and edit. Let me go back into this one. I'm going to click Edit. I'm going to make this one red. I forgot to do this earlier. Make this one red so it's a little bit more clear what we're dealing with here, okay? So this red line here is going to be my shorter term moving average. In this case, I'm using a 50-day simple moving average, and the blue line is my 200-day moving average. Now, the longer time frame you use, for example, a 50-day moving average with a 200-day moving average is that's going to give you setups over a couple days, whereas if you're looking at a 10-day moving average compared to a 40-day moving average, that's going to give you much more shorter term plays. So the longer time frame you use, the longer you can expect that play to develop. So here's some good examples here of golden crosses. Here we have this red line, which is our short-term moving average, crossing up above our longer-term moving average. And look at the price action we get from it. We get some major spike from the 250 area all the way up to about the 290 area. So a fantastic spike up and over that area. And as soon as we get the death cross, which is right here, look at the major sell-off we get as well. So you'll see this is just an example of how these work, okay? Now, let's now talk about, so this is an example of golden cross with simple moving average. Okay, let's now talk about exponential moving averages. Okay, you can do the exact same thing with exponential moving averages. And in order to do that, I'm going to go ahead and show you. I'm going to click Remove All Studies to get rid of these ones. Let's go ahead and add exponential moving averages. Same thing. Head down here, moving averages. You're going to scroll on up to moving average exponential. It's going to add it there. Again, not too helpful by itself. So we're going to go back to Studies, and we're going to click Edit Study. Now I want to add one of its buddies, basically the same thing, so I'm going to go to moving average exponential. There it is, moving average exponential. Now I'm going to do the same thing. I'm going to make this a 50-day, and then that takes too long. Let's just type it in. I'm going to make this a 50-day, and I'll make the other one a 200-day again. I don't know why I'm struggling so much typing these in, guys. What is my deal? Jeez, come on. There we go, 50-day, and then let's go ahead and make this a 200-day. Not 29. Jeez, the struggle is real. I don't know if my ThinkOrSwim platform is glitching and struggling, or if it's just me. It's probably just me. But the struggle is real. Come on, one more zero there. There we go, okay. So now I have the exact same setup, but slightly different exponent. Oh, again, I forgot to make them a different color. Definitely want to make them different color so it's easier to tell what you're working with. So very similar setup. The only difference is you can tell with these exponential moving averages is they're a little bit more lagged. And the reason that is, they trade a little bit tighter to actual price action. And the reason that is because the most recent days are weighted carefully. So I'm not going to get too much into the difference between simple moving average and exponential moving average. And I mean, some people like some more than the other. But the idea behind them and the golden cross is very much the same. I personally lean more towards using exponential moving averages because they're a little bit more reflective of current prices, but just my feelings there. So now what I want to do, I want to overlay. Oh, another thing you can do here is to save your study set. I strongly encourage you to do this. Once you bring this up, simply save the study set by clicking on Save the Study Set here. This is exponential. And I'm going to put 5,200. So I remember it's exponential moving average 50 and 200. So then in the future, whenever I'm looking at a chart, even if I remove all these studies like this, I can quickly bring up these exact studies by going load study set, exponential 5,200. Just like that will bring it right up for me. Very, very helpful and very quick. Now, one more thing I want to talk about here. I want to compare a simple moving average and an exponential moving average. Then we're going to get into MACDs a little bit. So here is the exponential moving average, 9-day exponential moving average in blue. And I'm also going to add the simple moving average here. Now they are both in blue, but let's see if we can. Oh, it only laid one of them. We have to go in like this, edit study, and then go add in this way, add the second one. Otherwise, it kind of kicks the other one out. So there we go. We have simple moving average in already. Let's put an exponential moving average right there. Okay, and I'm going to make one of these red so it's very clear. We'll make our simple moving average red here, whereas that one is blue. Good. Okay, so these are the exact same setup. They're on this exact same time frame. The only difference here is one is simple moving average and one is exponential moving average. Let me zoom in a little bit closer so you can get a little bit better idea of the difference between them. Now, as I mentioned, this red line is a simple moving average, and you'll see it's a little bit more delayed than the blue line. The blue line tends to trade a little bit more tight to price action, and the red line seems to just almost be like 30 minutes to half hour or so behind the blue line. It tends to lag a little bit, whereas the blue line will be more reactive to actual price action. Okay, so that's the difference between simple moving and exponential moving averages. They can seem really small and insignificant, but it is worth noting. There is a difference between them. So play around with them and get more comfortable with them. Now let's talk about MACD real quick. MACD is a little bit of a different game here. Let's bring up MACD here. So I'm bringing up MACD, but here I went on quick study. I went to all studies. Then I go to the first M, L through M here. And then I go ahead and click on MACD. Okay. Now MACD is already set up with 2 lines for us. We don't have to go in and add a second line. The reason why it has a second line is because, as I mentioned in the slideshow, MACD is always paired with basically a signal line, kind of like a trigger line that we use to base things off of. Let me move things around so you can see it's a little bit more clear. So this is our MACD action. This blue line is the actual MACD line itself, whereas this kind of grayish line, yellowish line is our trigger signal. So golden crosses work very much the same way. When you get the MACD crossing up over the signal line, that's a signal to buy. When it crosses under, that's a signal to sell. So golden crosses and death crosses work very, very, very much similar to simple moving averages and exponential moving averages. So all these moving averages are really extremely similar, but there are different tweaks and things you can do with different setups and whatnot. So I encourage you to play around and kind of get familiar and find one that you like the most. I hope that this has been helpful. Just to review real quick, I just want to talk again real quick. We talked about the MACD, we talked about the golden cross, we talked about the rolling window that moving averages work within, and we also talked about the simple moving average and the exponential moving average. I hope this has been helpful. If it has, please like this video, comment your thoughts. Yeah, I thought this was awesome. Yeah, I thought this was garbage. Please let me know. I always appreciate the feedback. And head to kfinvesting.com if you want to try out our chat room. I give a 1-week free trial. We'd love to have you in, and follow me on Twitter at kfinvesting. So again, I hope you enjoyed this video. Feel free to like, comment, and subscribe.